Good morning, and thank God it's Friday. The world surely needs a break from this roller coaster ride that the US president is hell bent on putting the rest of the world through. So let's see what the headlines have to say. The week's news is definitely dominated by the US president's tariff wars, and jostling for attention is the RBI governor from India. Let's see what all is there. Cargo rush as full Trump tariffs take effect today is one of the headlines on Wednesday's Business Standard. And before the tariffs take effect, a lot of producers and exporters have been trying to push as much produce as possible into America and save costs. There's a report saying that Apple has shipped 6 plane loads worth of iPhones to the US. About 1.5 million iPhones have been shipped to the US before the tariffs take into effect. Otherwise, China and India, who are the largest producers of iPhones for Apple, could see higher tariffs. China far more than India, and Brazil is also another producer of assembler of iPhones to make it cheaper for them. And some good news. The SkyMet forecasts a normal monsoon for India, which is good news because so much of our economy and consumption, FMCG, depends a lot on agricultural produce. And we are hoping and praying that, yes, SkyMet is right. With the volatility in stock markets and markets having fallen so much in India, just like the rest of the world, IPOs are getting postponed. So some of the IPOs that were planned by large companies such as LG and the EV maker Ather, both are likely to get postponed, and they'll look for healthier times to move. So generally IPOs come in during bull markets when they can get the best pricing for themselves, not the investor. Another headline says, tumbling commodity and oil prices, bad omen for India Incorporated earnings. Okay, so that has it's a dicey statement in the sense that there are two views to it. If you are consuming the raw materials, obviously you're going to make your final product cheaper. But if you're producing the raw material, then you're going to have lesser margins. So there will be the haves and the have-nots. Those who produce oil, those who produce metal, steel, etc., they will face pressures on their product pricing, whereas the ones who consume it, like automobiles and paints, etc., they will find the raw material input prices coming down, improving their margin. So somewhere on an aggregate, it would balance. But if you're looking at it sector-wise, obviously some sectors would have depressed earnings and some sectors will benefit from this depressed earnings. So we have actually seen oil falling by almost 8.5% the month to date, which is a large one. Okay, oil is closer to now $60 a barrel on Brent, and NYMEX is a little lesser. And as oil prices come close to 60, you're going to see a lot of calls from oil producers wanting to shut down production and shut down rigs, especially in the US, where they're far more sensitive to price pressures. And anything close to 55, they don't make money. So in between 55 and 60, they make some money, but not a lot. So you will see that as oil prices fall, a lot of more calls to shut down rigs in the US will be happening. And let us remember, folks, that the OPEC plus countries have also decided to ramp up production and bring down oil prices in the process. Oil is falling because the world thinks that they are going to an era of slower growth. And if there's slower growth, there will be a lower consumption of oil. And hence, with adequate supply and lower demand, you're going to see oil prices fall. So we see this play out with different cycles. So, and one should note that Iran is coming forward to engage in peace talks with the US. Which means that the prospect of a conflict between these two countries comes down, and that much pressure is off oil supplies. So all these things are happening. It's just not impact of tariffs. There are geopolitical activities also happening which are impacting these prices. Okay, and A lot of deals between US and India are on hold because nobody is clear what would be the impact of the tariffs and what would be the eventual result of tariffs. Are they going to be negotiated? Are they going to be drawn back? Would there be a minimum? Would there be a maximum? There's a lot of mystery there. So orders on exporters from India are on hold. New deal negotiations are on hold. So this is going to slow down things for us. Then we have, of course, the Reserve Bank of India's Monetary Policy Committee that met this week. And yes, the headline says RBI slashes rate and shifts stance. That's great. So the RBI finally decided to reduce interest rates in India by another 0.25%. The first cut was in February and the second cut in April. And now it is from 6.25% to 6%, which is great for India Incorporated and retailers because it brings down borrowing costs for everybody. There's a caveat though. While the RBI may be reducing interest rates, if there is not sufficient liquidity in the market to transmit these rates, the rates do not get transmitted. So far we saw rate cuts happening, but the end borrower were not really feeling the benefit of it because there was not adequate liquidity in the system. So since the last 1.5 months with the new governor coming in place, he has promised enough liquidity and has kept up his word. And even in this monetary policy, he has clearly said that we move from a neutral monetary stance to an accommodative monetary stance. So what does that mean? Let's see what some of the analysts have to say about the monetary policy. So there's a column by Tamal Bandyopadhyay called Bankers Trust, and he's one of the analysts who closely follow what happens in the banking industry, and very often he's right. So let's see what he says. He says, finally, the Reserve Bank of India has kicked off an easy monetary policy regime. Okay. The Indian Central Bank on Wednesday reduced the policy repo rate by 25 basis points to 6%. Okay. This was the second successive rate cut since February. More important than the rate cut is a change in the monetary policy stance from neutral to accommodative. And both decisions of the 6-member MPC were unanimous, which is good. Okay, so RBI Governor Sanjay Malhotra's statement explains what an accommodative monetary policy means. He says it is geared towards stimulating the economy through softer interest rates. This implies that more rate cuts will follow. This is excellent. Okay, so inflation is also down from 4.2% estimated inflation in FY25. The RBI has revised it to 4%. So there's very much within the Reserve Bank's inflation targeting. So inflation coming down, there's definitely a clear possibility that interest rates can also come down, and along with inflation. For the record, the last time the RBI had changed its monetary policy stance from neutral to accommodative was in June 2019, when it had cut the repo rate by 25 bips to 5.75% in order to support economic growth amid concerns of a slowdown and benign inflation. This had been after maintaining a neutral stance since February 2017. So you can make out this quite a milestone change in the monetary policy stance of the RBI. Okay, so let's hope that this works and this is going to help India do better on the growth front. US bond rout rings alarm bells across world markets. So I think for a few days to come, it is US and the happenings in US that is going to dominate economic discourse and market events. It is so impactful, so important for all of us. So US treasuries fell. Initially, the US treasuries are US government bonds. Initially, the prices went up, and you had the yield coming down from 4.5% to 3.9%. Okay, and a sudden spike after that, the huge sell-off in US government bonds yesterday and day before yesterday, and the yield shot up back to 4.5% from the pre-Liberation Day levels. And this has really spooked bond markets. So such sharp sell-offs are bad, because if the US is wanting to borrow more, they will have to borrow at higher rates. And if there's more volatility and more risk that is perceived in these bonds, then investors will demand a higher yield out of these, which is going to make it far more expensive for US to fund its deficits. Let us bear in mind that almost about $38 billion of bond refinancing that is coming up on April 10th. Okay, and let us see how the world reacts to this round of borrowing by the US government. It's quite a nail-biting series of events that have been happening. But why did such a massive sell-off in US bonds happen? So there were a number of conspiracy theories. It started with saying that China is selling US Treasury bonds and retaliation for tariffs, and they're kind of punishing US for it. But that did not turn out to be true. There are two things that happened. Because the risk in the bond market went up, all those institutions and hedge funds who had actually borrowed money to buy long-dated, long US Treasuries suddenly realized it was not worthwhile to borrow and invest. So they had to sell off their positions. They had to unwind their positions. And the process of unwinding, they had to dump a lot of bonds, and the prices fell. It so turned out that it was a very large Japanese hedge fund that sold more than $60 billion of US Treasuries, prompting this. This bond sell-off had an unintended consequence, which was good. It forced the US president to rethink his tariff policy actually and announce a 90-day pause. This is a big win for the rest of the world, and I see a number of congratulatory messages on Twitter, or rather on X, thanking the US hedge fund for having sold and forced the US president to rethink his stance. So now the tariffs are relaxed for a 90-day period, but the tariffs on China have increased only because China wanted to or decided to retaliate by putting a reverse tariff on US exports to China. Okay? So this trade war is going to get ugly, only because the two largest players are not going to be backing down. US and China are not going to be backing down. They're going to be fighting, and that means the rest of the world is going to see unintended consequences, and it will be suffering. It cannot be insulated and distant from all this. So I'm just hoping that it turns out well. Amidst all this, because inflation fell, FMCG stocks outperform on lower inflation estimates. So if with lower inflation, the first FMCG stocks, they consume a lot of such raw materials, and if their input prices are coming down, then it means better margins and better demand at lower prices for the end consumer. So actually FMCG stocks went up while the Nifty as a whole fell down. You saw some of the stocks from Godrej Consumer going up 3.8%, Britannia up 3.1%, Nestle up 3.1%, Imami, Colgate, and so on and so forth, all were up between 1.5% to 3.5% on inflation being perceived to be much lower. Okay. Mint says, why is private equity money in real estate falling in India? After many years of very good flows into real estate, this year we have seen lesser. So it says, PE investment real estate have declined over past 5 years from 6.4 billion in 2021 to around 3.7 billion in 24-25, including the amount and the number of deals, both have dropped. So it could be indicating that investors are unwilling to take risks. So unless they see and perceive a lot of safety in the country where they're investing, they're not going to be increasing their commitment. Okay, so we had a period where residential real estate did very well, and now it could be slowing down a bit. The pace of launches, of new launches, have come down. So this all relates that if there is a slowing market, it is a reason why private equity deals have also come down. Okay. The commercial office sector, which has traditionally attracted most investments in real estate, saw a steep decline in investment, 806 million in FY25 versus 2.2 billion in FY24, despite very robust leasing activity. Okay, this indicates investor caution. After a stellar run, the residential sector also saw a fall in average deal sizes. However, international equity interest is again emerging in this sector. So it seems to be going through cycles and very sector specific cycles. There's another article which says that as compared to the rest of the world, office leasing rates in India have been far more robust. Unlike what's happening in some of the larger US cities or Shanghai or Hong Kong, in Mumbai and Bangalore, leasing rates have been actually very robust. And when you look at the office per square foot leasing rates, with just about around $1 or sub-dollar, it is way cheaper than most of the other countries, which is why it makes it very attractive for global capacity centers to be expanding in India and setting up centers in India. Their operating cost is way lesser than other countries. Okay, so also we have been seeing a higher absorption of office spaces because of actual expansion, team sizes expanding, which is actually bodes very well for the growth of the sector. Going on, says, why has warehousing gained favor? In FY25, logistics and warehousing made up 48% of total investments, the highest in 5 years. So investors have shown more interest in the booming warehousing sector, with demand propelled by manufacturing, e-commerce and third-party logistics growth. Global investors such as Blackstone Group are building their warehouse businesses in India, which is great. Then let's come down to today's newspaper. TCS announced their quarterly results yesterday, and the headline says TCS net profit slips 1.7% in Q4 and misses estimates. Okay, so IT stocks have been having a hard time because they perceive IT businesses to be slowing down. And why do they think IT businesses are slowing down? Because of recession fears in the US. We do know that deals are held up, and more than $20 billion worth of deals are currently being held up because nobody's sure of what's going to happen next in the US economy. Okay. So the managing director and CEO of TCS says, we had spoken about improving market sentiments and early signs of revival in discretionary spends in January. But this was not sustained due to the discussions around tariffs. We are observing delays in decision making and project ramp-ups with respect to discretionary investment, he told the media during the Q4 results. Net profit margins have also dropped to 19% from around 21% for TCS, doesn't bode very well. As a result, they have also deferred salary hikes amongst all this global uncertainty. So there are going to be a lot of second order and third order consequences to the US tariff war. And a fantastic editorial in today's newspaper, T.T. Ram Mohan, who's an analyst and economist, writes about the Trump tariffs. Who will have the last laugh? Okay, he says Mr. Trump may temper his approach from time to time, but to think that he will change his basic philosophy is delusional. There may be pauses, but he's not going to change. But what I found very interesting in his editorial, there was a lot of data that came out which we have not seen so far, and gives us a very different perspective on what's happening. I would not be wrong to say that most of the reports that I've been reading have been against Trump's philosophy. And here he's shedding some light on why it could be working. So let's see what he says. Okay. Amongst the other qualitative ones, the most thing is, if the version of free trade we have had in the past decades has brought prosperity to America, why disrupt it? Why are you breaking something that is going good? Has been the general criticism of Trump's tariffs. So let's see what Ram Mohan has to say. It says, numbers such as the gross domestic product growth rate or increase in per capita income can be deceptive. They don't capture the fact that the benefits of so-called free trade are unevenly distributed. That is certainly true of the US, where we have been seeing a concentration of wealth in just the top 1% of the families. So there was a statistic seeing that the top 10% of US families account for 69% of US wealth. That's a massive disparity. Robert Lighthizer, who led the assault on free trade in Mr. Trump's first term, says that in the last 16 years before China joined the WTO, real medium household income in the US rose from $53,337 in 1984 to $63,292 in 2000. Thereafter, real median household income fell below the 2000 level, and it remained there every year until 2016 when Mr. Trump first became president. Even in 2016, it only reached $63,683, an increase of less than $400 in 16 years. The US economy grew, but the average person lost out. When Mr. Trump stepped down in 2020, median real family income was up by 6.8%. Economists ascribe the increase to Mr. Trump's notable initiatives such as tariffs on Chinese imports, the renegotiation of NAFTA, and the tax cuts of 2017. Together, he says, Mr. Trump's initiatives caused thousands of manufacturing jobs to return in his first term. That is the source of Mr. Trump's appeal to the American middle class, and it explains his electoral trumps in 2016 and 2024. He's saying basically that his policies worked in the first phase one of his presidency, when median household income actually went up after 16 years of not doing anything. Okay, something to note, and that's possibly what he wants to repeat in the second term. Okay, and the other point is that the tariffs announced by Mr. Trump are a negotiating tactic and will be rolled back once America's partners enter into negotiations. Mr. Trump has indicated that he is open to negotiating reciprocal tariffs with America's trade partners, and the 90-day pause is intended for that purpose. So let's hope these things work out. Another interesting article here by Ajay Kumar, Off the Grid, India's untapped data gold mine. Okay, he says India leads the world in digital data generation with 450 million Facebook users, 540 million WhatsApp users, and 490 million YouTube users, the highest for each of these platforms globally. Additionally, 82.6% of email users in the country use Gmail, and 360 million are on Instagram. Massive numbers. Okay? Despite producing an estimated 20% of world's data, India lacks the infrastructure to fully harness this resource. Okay, so like he says, we are failing to capitalize on our strength. China controls 70 to 80% of rare earth processing, Australia dominates iron ore mining, and Chile leads copper production. But India, which is a huge data mine of data, is not doing anything about it. Okay? Given India's share of global data generation, it should have at least 20% of data center capacity, but it has only 2%. Okay, so this is a greenfield sector which is waiting for investments to take place and can create a lot of high quality jobs. Okay, this would require about 40 gigawatts of power. Today's data center capacity that we have in India is hardly 600 to 900 megawatts of consumption. Okay, so way to go here. I think at the end of the week, what we have been seeing is that gold jumped up 4.3% during the week and 8.1% for the month to date. Oil slipped 8.5% for the month to date. The Nasdaq came down 6% for the month to date and went up 2.1% during the week. The S&P 500 fell 0.5% during the week, and overall during the month to date is 5.5% down. The Nifty fell 1.1% during the week and actually went up 1.5% during. We have been seeing wide divergences, and each day's volatility we have not seen in the recent past, with 7%, 8%, 10% swings in a single day. But through all this, if you are seeing, outperformers have been FMCG and the banking sector. FMCG went up 3.1% during this month, whereas the market fell 4.8%, and banks fell only about 2.6% so far in the month. So most of the funds are having at least 1/3 in banking and financial services, which sort of shields it from the kind of fall that we've been seeing in the other sectors. and FMCG, of course, has been a great performer. So I'm hoping that we are only going to be seeing improvement in all these as negotiations begin between countries and the US. Have a great weekend, folks. Thank you.